Hey, good morning, everybody, and welcome to a daily market report brought to you by Mike Bjork. Today is Tuesday, August 2nd, and we'll cut right into the economic news releases that were scheduled for today. We'll begin with the personal incomes, and for May it was 0.2%, and they're estimating for June a little bit of a drop, 0.1%, and it came in right at estimates. So the next item up is personal or consumer spending, and that was at for May. It was up. It was at 0.1%. They figured it would remain about 0.1%, and actually came out negative. So people were more saving than spending. So two negatives against where the economy is looking, because obviously people are making less money, and then also they're spending less money. Obviously, we need people making more money as well as spending more money to get the economy rolling the opposite direction. We'll take a look at the core PCE, and this is the personal consumption expenditure. This is the Fed's favorite gauge for inflation. And the numbers for this one was for May, it was at 0.3%, which was pretty high for a pretty big jump for inflationary numbers. We did figure it would drop a little bit, and it did actually. It dropped down to 0.1%. So on the inflationary note, actually, and this is the core here, and that's stripping out the volatility of food and energy, came in at 0.1%. So that's a lot more reasonable and for us. And as kind of the Fed said, the second half will kind of simmer down a little bit with the inflationary numbers should come down a little bit. So right now, at least this early on, it looks like maybe there's some truth to that. So 0.1% is pretty good growth there. So let's go ahead and take a look, see what all this leads to the stock market. Stock market is actually down again. And well, I guess I forgot to put that on there. Stock market's actually down. And yesterday, the House passed the debt ceiling measure, and then Senate went ahead and got that through this morning. So that's also good news. We got that behind us. So the other headline news is back to the focus on that crisis back in Europe. And right now, with the yield spreads increase, the yield premiums that are on the bonds, the countries are paying have increased for Spain and Italy, because that's where they think there might be another crisis at. So we've talked about Spain before, but Italy's been kind of mentioned the last few months, also in that same category. And obviously that's important to get addressed as well. So there's still obviously a lot more concerns in Europe right now. So let's go ahead and take a look at where the bond market and where interest rates are going. We have another nice little rally going on today. We have another opening gap here, and then we had this opening gap here. This won't be sustained. We're going up there too quickly. I would anticipate, interest rates today are better than what they were. We're actually above the 102 mark, which we haven't been there probably actually almost a year ago. We haven't been at this mark. And again, I would, if you're in the process, I would definitely look at maybe, maybe locking in. The fundamentals do hold this. I mean, it does support this, but usually gaps we don't have too much bearing in there. And I would anticipate some type of profit taking by the bonds, and then you'll probably see a drop, and then probably work its way back upwards again. So I would definitely kind of watch out. I think I would look kind of towards kind of watching, and maybe I wouldn't really necessarily flood at this point. It looks because the last couple times we've been up in this range, it's been actually it's actually dropped. So all right, folks, you guys have a wonderful day. We'll kind of cut it here. And again, if you guys are looking to do any home buying or any refinance, go ahead and take a look at my website at CaliforniaMortgageTips.com. You get a lot of great free reports there. And if I could be of any assistance, go ahead and contact me. You can find me again through my CaliforniaMortgageTips.com website. Have a great day.